All right, good morning, everyone. We will get started and let anyone that's late come walking in. I'm Amanda Smith, Extension Economist here at the University of Georgia Tifton campus. Good to see a lot of familiar faces. As usual, I'm going to talk about what's going on with the inputs and the overall environment for growing, and then cover the crop comparison tool as well, just so we can see what numbers are looking like. All right, so for the economic environment for 2025, my keyword has been uncertainty. There's a lot going on here in the US and the rest of the world that is creating a lot of uncertainty. Will we have a new farm bill in 2025? So as you know, at the end of last year, there was a continuation of the farm bill, and as part of the continuing resolution. And then there was an emergency financial aid package passed with that, and I'll talk a little bit about that in some following slides. There's some push by the Ag Committee to have a farm bill the first quarter of this year, but several people were interviewed at the American Farm Bureau meeting last week, or this week, I don't remember what day it was, and they're not sure if they can get it past this first quarter because there's a lot of other things that Congress needs to deal with. From the agriculture side, and particularly for cotton, there's uncertainty as far as tariffs. The overall takeaway from the Ag Forecast, some of the panelists that we had at the Ag Forecast last week, was that they're really expecting those to be used as a negotiating tool. If in the case there are retaliatory tariffs, there's hope that a package will be put together similar to what we saw the last time we experienced significant retaliatory tariffs, like a market facilitation program. Of course, that is all left up to be said and to happen, but there's hope that something like that may occur in the case of retaliatory tariffs. Trade is certainly a big issue and a top priority for the new administration that has come in. So hopefully some new trade deals can get brokered, which would be really critical to the cotton industry. Also, labor and immigration, inflation, extreme weather events, and continued geopolitical turmoil is going on. I'm not going to spend much time talking about global growth and GDP. This is basically the International Monetary Fund's prediction of global growth, and it's relatively stagnant. So slight growth, not anything big and extreme or to get overly excited about, which is unfortunate in the case of cotton. Cotton demand goes up significantly when we see global growth in demand. But I'm sure Dr. Liu will talk more about that. Overall, commodity prices are down except for the case of corn compared to a year ago. This is actually dating back 5 years, and I've highlighted in the yellow bars kind of the pandemic period. So compared to about a year ago, corn is about the same as it was last year, but everything else, cotton, soybeans, and wheat, are lower than they were a year ago. Now, that actually means in some cases we're actually seeing prices down to where they were during the 2018 Farm Bill. So we're going to see a payment, PLC payment for those that have seed cotton base, and also in the case for peanuts as well. Cost of production is still inflated, so as you all know, margins continue to be tight and sometimes negative on rented land. Looking at trade, this is a priority for the administration as well to try to lower the trade deficit. We saw a jump in November and expected in the December 24 data as companies imported products into the U.S. prior to proposed tariffs that were announced after the election. Also, there continues to be inflationary pressure in terms of increased shipping costs and transaction costs for shipping our products. Again, this is really important for cotton because we export our cotton and then import textiles and cotton products. All right, so labor, obviously a really, really important issue for agriculture. I don't need to talk about that too much because it's obvious. We've been dealing with it for years. How will immigration reform happen and what impact will that have on agriculture? We all know that it's expensive to pay for good labor and to try to keep it as well. Interest rates, the word on the street is that we're probably going to see 2 cuts proposed in 2025 as opposed to more like we saw in 2024. So they're a little more hesitant to look into reducing cuts in terms of interest rates. So right now we've got farm operating notes around about 8% in our enterprise budgets and information for your planning purposes. Already mentioned the Farm Bill, and then I'm going to talk a little bit about the financial assistance in terms of economic aid. So really quickly, just talking about the Farm Bill, there is expected a payment for seed cotton base acres for those that didn't do stacks and they elected PLC for their seed cotton base. So looking at that information, the effective reference price minus the market year average price is 0.024 cents a pound, or about that. And that works out to a payment rate of just under $52 per acre. So in this example, $52 per acre if you have a seed cotton yield on your base of just over 2 tons. So that is all going to vary based on your farm PLC yield, but I just wanted to show you an example here. The rate per acre, $51.20 on 85% of base acres. Say this farm has 300 seed cotton base acres, they could see a total payment of about $13,000. So you can kind of do some math and estimates based on what you might have chosen for your farm in terms of your base acres and your yield. This payment will be received in October of 2025. Now that is based on the 2018 Farm Bill that was extended. Now if we do get a new Farm Bill, and that is retroactive, like they go back in time, we could see some changes to that. But I don't know if that will happen or not. So as of now, the current Farm Bill, and this price could still change, or this price right here could still change. That's the estimated market year average price for seed cotton right now, as of January 10th. Okay, looking at the economic assistance that was proposed, so $10 billion in financial relief was signed into law for farmers at the December 21st last year. And we know that you should receive, for growers that farmed in 24 and 23, should receive a payment by March 21st. Now the question is how much that is going to be. So the proposed legislation, depending on the math and the calculation, what exactly formula you have, this is an estimate of what the proposed payment will be per acre. According to Joe Outlaw and Bart Fisher from Texas A&M Ag Policy Center, based on their years of experience, they feel that $10 billion might be prorated because it has to be spread out over 21 different commodities. And it's only $10 billion, which is not very much. So they think it could potentially be 85% of that, but some feel really strongly that that was proposed in the legislation and this is what the payment will be. So hopefully I've got a worst case scenario and a best case scenario for you, but we should know by March 21st for sure. Just want to put a plug for Southern Ag Today. This is a really great little website put together by Extension Economists from the South, particular to the South. A lot of people have heard before this one, Farm Doc Daily, I think that was one, but that's mostly focused on corn and soybeans and out of the Midwest. So this one focuses specifically on Southern agriculture, cotton, peanuts, rice, livestock, all of that, and each day has a different topic, whether it's farm management, marketing, or ag policy. Also, we have specialty crop features as well and trade. So if you're interested in getting a short little blog put together by extension people so it's not way up here talking about theoretical economics way over my head, this stuff makes sense. So highly recommend it. I use it for a lot of my info as well. All right, talking a little bit about interest rates. We are like 4 some odd percent for the effective federal funds rate right now. Potentially have 2 reductions next or in 2025. But I wanted to extend this back to 1965. So according to the Ag Census, the average age of a farmer is 58 years old, 58 or 68. So I extended it back to the life of a farmer just to see historically what interest rates have been. And we had periods of really high interest rates. That was the horrible 80s that no one wants to remember or live or experience again. But since then, they've been down lower. It was just in like mid-2000s, 2010s, and so on when we had interest rates near zero. So the likelihood of those going back to that point in time is pretty low. So maybe we need to get used to a new normal of interest rates or federal fund rate around 4% or so. I think their goal is actually to get it down around 2.5%, as long as they can keep unemployment and inflation in check. But that means interest rates for the rest of the world, 6, 7%, and so on. This is basically looking back in time to see what happened last year in terms of production expenses. The dark blue is 24 and the light blue is 2023. And last year we saw reductions in feed, obviously, because the commodity prices are lower. Fertilizer prices went down, seed, chemicals, and fuel. But rents, property taxes, interest, livestock and poultry purchases were up, as well as labor. And for 2025, we're probably going to keep fertilizer down. Seed will probably be stable. Pesticides probably down as we see more growers using more generic chemicals, trying to figure out the most economical way to produce as much yield as affordably as possible. And fuel is certainly down as well. Rents, hopefully we begin to see those stabilize. They might increase again, but last year they didn't increase as much, and so on. Obviously for lenders and those lenders that are in the audience, top concerns are certainly liquidity and working capital. Just seeing that ability to pay current debt that's due within a year is starting to erode. And those growers that are losing their working capital, it makes it harder for them to expand and grow their operations and invest in things that work. Obviously, farm real estate values are still really important because of the credit that they provide. For Georgia, it moderated a little bit. I think for 22 to 23, it was an 8.9% increase in farm real estate values. For 23 to 24, 5.4%. I know you can't see that, but we're looking at an average value of $4,500 per acre there. So cash rents, this is what happened in 2024. And this slide makes me a little bit anxious. I was at a meeting yesterday and I actually didn't show this slide. We talked about some other things. But the agent was like, I'm actually kind of glad you didn't show the cash rent slide. It gives my growers a lot of anxiety because they're worried that landowners are going to see these numbers and say, ooh, we need to increase land rents, or ooh, maybe we're not charging enough. So I want to say this is just an average for Georgia. And there's a lot of variation across the state of Georgia from north to south, east to west, county to county. So this is just average data that's collected from the USDA National Ag Statistics Service. But the thing that I like to take away from it maybe is not that hard number itself, but the trend. We saw them go up about $5 per acre for irrigated, non-irrigated cropland. Pasture land actually went up a little bit as well. Compared to 22 to 23, it was not as much. So landowners obviously hearing the message that, okay, it's going to be tight. Margins are going to be really tight, especially on rented land. We can't increase it that much. And unfortunately for 25, that case is looking to be the same again. As far as fuel, the U.S. has put out quite a bit of oil. This is the West Texas Intermediate cash contract for oil future prices. Global supply is relatively high. Demand is actually down. And if you go back to the IMF global growth forecast, it's just a little bit. So kind of growing along with population. So the expectation is for demand for fuel not to really go up. So we're probably going to see lower prices for diesel fuel this year. I'm actually using $3 for farm diesel in the enterprise budgets for 2025. So that's quite a bit lower than we've seen in a long time. Fertilizer prices are down as well. You saw that trend in that previous slide from USDA Economic Research Service looking at the different comparisons in production expenses. And so we've seen nitrogen prices come down. This is the cost per pound of nitrogen. The other slides are going to be per ton in terms of the graph chart. And so we're looking at an annual January through December on this. This chart is going back 10 years. But these ones, we're looking January through December. So we're kind of looking at a seasonal behavior of fertilizer prices. The dotted line is a 5-year average. The purple line is 2023, the green is 2024, and red is what we're seeing right now. So urea, much lower than it has been past 2 years, and certainly lower than the 5-year average. Phosphorus ranges in price 56 to 83 cents a pound, so there's a lot of variation in phosphorus price there depending on the source that you're using. But looking at DAP, we are a little bit higher than 2024, but below 2023, and still above the 5-year average. And then potassium, we're quite a bit lower than the 5-year average, and certainly lower than 2024 and 2023 so far. Now, the reason being is there's ample supply of nitrogen, ample supply of potassium. However, because of the tariffs and the fact that we import a lot of potassium and a significant proportion of phosphate, there's more sensitivity and volatility that may occur for those nutrients. You can see the prices that we're using for the enterprise budgets right here. They're quite a bit lower than they were last year, except in the case of P, which is actually higher than it was last year. So there's the overall outlook for inputs. I'm not going to repeat myself, but now I'm going to pull up the crop comparison tool just so we can look at the numbers. Now this has been, gosh, this is probably the 15th or 16th year that the crop comparison tool has been published by the Department of Ag and Applied Economics. So it's not the first time that many of you have seen it. We have the budgeted yields in there, and the prices in blue are the season average, expected season average price based on the futures contract, the harvest time futures contract adjusted for basis. So we've got that in there. We could maybe bump corn a little bit up because that has gone up some. However, I'm a little bit hesitant to do that just because the expectation for a lot of planted acres of corn this year. But when you're looking at this, so this is taking the budgets and putting them side by side so you can compare the potential return of a variable cost. And that's what you want to look at when making planting decisions. Keep in mind we don't have land rent in here, so you'll want to plug in your land rent value and see how that impacts your bottom line. And also yields. Now, I've been at peanut meetings, I've been at cotton meetings, and they're actually surveying peanut growers, and I know a lot of cotton growers are peanut growers. And we planted a lot of peanut acres last year, and they're surveying growers what the plans are, and depending on where you're located, there's some that are saying we might plant more peanuts, And we planted 850,000 acres of peanuts in Georgia last year. So if we plant more, that may mean that we're shortening rotation. And if that's the case, we need to think about how does that impact yield or disease control? Like, will we need to put out more disease control? And then how does that impact the bottom line? So the cool thing about this is you can change yields. So I think this, for Georgia, we were actually 200 pounds below usual. And then maybe say we add an additional $25 in fungicide spray. Oops. Oh, sorry. Yes. I'm used to the keypad working and it doesn't on this. I've got to... So those are things that I wanted to show you, features that you can do with this tool to evaluate how decisions may impact that bottom line. You can change yields. You can change yields for cotton, chemicals, fertilizer prices, all of that. If you want to change fertilizer prices as a whole, at the very bottom of the crop comparison tool, you can change that. Or diesel. So $3 a gallon. I saw somewhere it was $2.92 for farm diesel. Maybe you can get a steal on phosphate, 68 cents a pound. Oop, that one's way too expensive. Thank you. So just some things that I encourage you to do to change the numbers and make them reflective of what your production practices are and methodology. Any questions or numbers that you'd like to see changed, maybe take a look at non-irrigated. I didn't mention about the natural disaster assistance. There has not been very much information about that, but there was $21 billion proposed in the legislation signed into law December 21st with the financial assistance, but there was not really much released about it, so we don't know what states will get it and how that will be distributed. So there's also that that may impact several of our Georgia growers because of the natural disasters we faced in the state in 2024. So any questions before I turn it to?
Where do we get that spreadsheet?
Oh, good question. I usually say that. Google UGA crop budgets and it will take you right to the page and it's right there at the top. I do have a website for you if you would like me to share it with you. But the easiest way is Google UGA crop budgets.
In your opinion, what would the new farm bill hold for cotton? Would it change I think the floor price might be brought up, or like what would you expect?
That I'm not sure. I don't have a lot of experience in the ag policy side, so I don't know. Anybody else have ideas, have experience on the ag policy side?
There are some discussions in DC before this administration that to increase reference price for all the covered commodities, but that's still under negotiation
Yes,
in
ma'am.
between the Congress.
It's what I was kind of hoping for.
Yeah.
Anyway.
And we all hope for that to happen.
Any other questions? Okay.
All right, good morning, everyone. I'm Yangxuan Liu. I work at the University of Georgia as associate professor. I'm great to see a lot of familiar faces. This morning, I want to share with you about the cotton outlook for 2025.
I want to apologize first. I don't have very good news for you guys for 2025. We need to adjust our planting, or we need to adjust our practice decisions quite tremendously in 2025. Last week, it put me something in thoughts because we have the ag forecast. There's some discussion between crop situation and livestock situation. On one side, crop situation looks very, not very promising, but livestock situation look very promising because the demand for a lot of meat and nutrient is very high. That makes me wonder whether there's some opportunity to diversify a little bit. I know it's hard to introduce livestock on the farm, but that's something I want to plug into your mind. Maybe consider some livestock rotation or some livestock grazing on the farm. That might help a little bit. But let's go over for on the 2025 cotton outlook. This is one graph from International Monetary Fund. They do economic forecasting every year for the global economy. So on this graph, there are 3 different lines shows up. The top line is emerging economy, middle line is the global economy overall, and the bottom line is the advanced economy. So emerging economy growth is slowed down for this year at 4.2%, and the overall global economy slowed down at 3.2%. Advanced economy, it rise up a little bit, but it's still very relatively slow compared a few years ago at 1.8%. So what that means for the cotton market, because cotton commodity, we purchase more cotton-related product when the economy are doing well, and we tend to shrink our purchase of textile and apparel purchase when the economy are not doing that well. So that's telling the overall story. In terms of global economy, there will be slowing down in terms of cotton demand for the next few years. One more thing I want to show is the Chinese economy, because China is the largest cotton consuming country in the world. A lot of the cotton gets shipped into China, make into textile and apparel, and then export to the global, to the world. What it shows over here is significant slowdown in the Chinese economy. Even though it looks very large number, 4.5, but if we compare to their historical growth, this is a significant slowdown. This is mainly caused by some crisis in the housing market. Their real estate value dropped significantly, and also because the economy are not doing well, a lot of young people are losing jobs. So unemployment rate in China is very high, and then the overall economy is not doing that good. So what we say in terms of cotton export from the U.S., we still export quite a lot of cotton produced in the U.S. to the world, but our export directly to China has been slowing down significantly. They used to be our largest cotton customers, but right now, because their slowdown economy, it impacted our cotton prices from there. This is a chart shows the global cotton supply, demand, and what is the ending stock overall. So what we see for the year 2024, supply is over demand. It's around little bit less than 2 million bales over demand, and that drives our ending stock high, a little bit higher than previous years. So we have more supply than demand. That makes prices lower than before. And on the other hand, the supply, global competition is increasing for the U.S. cotton tremendously for the past several years. So this shows the global production for the top 5 countries: China, India, United States, Brazil, and Pakistan, and then the rest of the world. What we see for the past several years, if you take a closer look at United States, our production has been varied, but overall has been down for the past 2 years. But if we take a look at Brazil, their production has been increasing. Last year, they produced more cotton than the US cotton. Brazilian cotton is a major competitor with the US cotton. Before, there are one competitor in the global market with US cotton, but right now, Brazil gradually became the biggest competitor with US cotton. And because of their production practice, and I'll show you a few slides later, Brazilian cotton is quite competitive with the production for US cotton. So here is a global major exporters by different country. And what we say is the top 4. United States used to be the top 1 exporting country. That gives us a lot of market power in terms of leading the global market prices for cotton. But last year, Brazil surpassed US and became the largest cotton exporter in the world. And you see the speed of how fast they're rising, except for the 2 years when we have phase 1 trade deal with China, Brazil cotton production export trend down a little bit, but all the other years, their growth is very steep. So to take a closer look at the Brazilian and US situation, this is a parallel comparison between United States cotton production and Brazilian cotton production. You can see for the past 10 years, they doubled their production from 7 million bales in 2015 to 14 million bales in 2017, while US cotton production, actually, I got it wrong, from 7 million bales to 17 million bales, so more than double their production. And if you compare US production, it varies a lot, but in the past several years, we have been producing a lot less. So that shows the global competition between US and Brazil increased tremendously. And it kind of let me wonder whether it's a zero-sum game. That means Brazil gained and US cotton lost in the global market, because the global cotton demand overall for cotton fiber is quite constant by all the global consumers. So to further show in terms of the production cost practice, there is a project that I've been working on with Agri Benchmark Group in Germany, and we have collaborators in Brazil too. So this is one slide we created by the Agri Benchmark, but the data from US is contributed by me and Mr. Hales from Mitchell County, and then the one from Brazil is contributed by our collaborators. So what we say is Brazil yield is a lot higher on average than US yield. According to USDA, Brazil's cotton yield is 1.8 times of US cotton yield, so a lot higher than the US. And excuse me, when we take a closer look at the cost of production between Brazil and the US, we see the different establishment costs, that is from seed, fertilizer, all the pesticide, herbicide, fungicide, and insecticide between Brazil and the US. We see the cost of seed and fertilizer are quite comparable between each other, between these two countries. What is the difference because of the cost of production is Brazil spray more herbicide, fungicide, and insecticide because of their disease pressures and weight pressures. Because of local weather, we spray a little bit less in the US. But when we compare about the operating costs, all the hired labor, family labor, cost of machinery, diesel, and contractor, we see Brazil have significant less labor costs and significant less in terms of machinery costs. One thing, I think I don't have it on the slide. Oh, I have it on the slide. One thing mainly caused the less of the labor cost and the less of the machinery cost is the economical scale. Their operation is 11 almost 12,000 acres for the farm operation compared to what we have relatively large operation, 3,000 acres in Georgia. The economic scale situation really helped them to reduce their labor costs on average per acre and also reduce their machinery, especially machinery costs on average per acre. So overall cost between US and Brazil, we are a little bit less on a per acre basis, but here is a per hectare basis, but it's telling the same story on the per unit land basis. We are a little bit less, but overall the two countries' cost is quite similar with each other. The concerning part in terms of the cost production is the cost production per ton or cost of production per pound of cotton produced between these two countries, taking the consideration of all the yield. So when we take in consideration all the yield, the average cost in dollars per ton for cotton, the Brazil cost of production is significantly less than US cost of production because they have higher yield. So that shows the competition in between the two countries. And the part is the triangle over here are the prices received by producers between the two different countries. What we can see is they receive quite comparable prices as what we receive over here. But if we take the prices over the cost of production, Brazilian producers making tons of money by growing cotton. So what's the incentive there? If they're making money, there's more incentive for them to increasing their production acres. So that means there will be more competition globally with US cotton. That's the overall trend situation. We cannot avoid it, but we can do some mitigation plan or do some plans to be able to mitigate the situation or expecting what's gonna happen in the future about the situation. So this shows the cost, the map of where their cotton got produced, mainly in the middle of the region, and a lot of the cotton got shipped to the port over here to get export to Asia countries. You have to go through here and mostly go to the Panama Canal or go through the south to go to the Asian country. But Brazilian government have some plans for increasing their internal transportation efficiency. So they are building roads, railroads to help building more ports on this region, which can go through the Panama Canal a lot quicker. So that has some potential for them to even more decreasing their cost of transportation of cotton. So why port is very important. Here is a port situation in the US for major cotton export. I got the data from American Cotton Shipper Association. This is the year of 2020 and 2021, but still telling the same story. The largest port for cotton export is in California, and then followed by Georgia. So that's one of the reasons, in addition to we producing high quality cotton in Georgia, the closer to the Savannah port gave us an advantage in terms of the cotton prices. We could receive some premium over the years compared to the rest of the nation in terms of cotton basis. So port is definitely important for cotton export. And then there's another one in around Texas for the third largest cotton exporting market, and then followed by North Carolina. So let's take a look at the US cotton situation in terms of supply and demand. In the year 2024, supply over demand for US cotton, we produced 14.3 million bales, but our total yields, including domestic yields and export, are at 13.1 million bales. So that increased our ending stocks a little bit to 4.4 million bales, and the oversupply is one reason that we got lower cotton prices for last year. And the upland cotton planted acre, harvest acre, and yield per acre, we have been planting a lot less cotton for the past 2 years, 11 million acres for last year, 10.1 million acres a year before compared to 13.6 in 2022. We harvest a little bit more this year because we didn't experience that bad of drought situation in Texas last year. And on average, our yield has been trending down overall in the United States. For last year, it's at 782 pounds per acre. And then U.S. cotton export and also our market share and export as a proportion for production. So the bar is the total value of export. As we can see, last year our export number dropped significantly, as well as our market share maintained as another level. Like if we call this over 30% is one level, and then around 27, 26% another level. So it looks like our global market share had dropped around 10% globally. But we still export a large number of cotton produced in the U.S. So overall, over 80% of cotton produced in the U.S. get into the export market. So the export situation is quite important for cotton. To maintain cotton prices, that's the reason why anything related to trade, war, or tariff, increasing in tariff or potential retaliatory tariff, that is not good market news for cotton. That's probably the reason why we see cotton prices has been trended a lot lower after the election result has been announced, because the new administration, there's a lot more discussion about trade situation or change of trade policies. So that is another thing that the market anticipate right now because of the uncertainty still there about the trade policy. So the market absorbs part of the uncertainty in terms of lower prices right now. So when the trade situation is more clear, there could be some potential for prices to rise back up, but expecting for the next few years, cotton prices probably not gonna be very promising. So we did economic modeling trying to predict in terms of planted acre for the coming year with my graduate student. So we ran some simulation and regression, and here is the result we projected for U.S. cotton planted acre in 2025. On average, a little bit higher than 2024 at 11.4 million acres compared to 11 million acres of last year. But still relatively low compared a few years ago. So in terms of Georgia production, the total cotton production in terms of million bales, last year we produced at 2.0 million bales. Because of the current low prices, that might further reduce some acres or maintain at current level in terms of million acres of production. So Georgia, for this coming year, I expected the production to be still around 2 million bales in Georgia for cotton. And here is the prices I pulled over from barchart.com for different level of future prices, cash prices for cotton for the old crop, for the 2024 crop, and then the new crop for the 2025's new crop. So what we see is prices currently are maintained at a relatively low level for both old crop and new crop. So that is something we need to make some adjustment in terms of whether change the production practice, whether to consider any rotational crop. I know there's not very many options, or to change some of the input decisions over the season to compensate for the low cotton prices. And because of the economic situation, I expected the cotton prices still gonna be maintained at a relatively low 70 cents per pound for the rest of this year. There are some factors to consider for 2025, and I want to remind you about it. One thing is to maintain liquidity and maintain cash flow is very important, especially during the situation low commodity prices, high input costs, as well as high interest rate. We heard a lot of stories that farmers saying, I'm not doing growing crop anymore. I'm renting my land to larger, more efficient farmers. So during this time, maintain liquidity is very important. And really need to think twice about equipment purchase, whether you want to lock into a relatively higher loan in terms of equipment for a quite long period of time. That is one decision you need to make. And then loan management in terms of the high interest rate. As Amanda mentioned, next year they're not going to be expecting a high cut of interest by Fed. So we're still expecting relatively high interest rate for commodity, for operating loans and also machinery loans. But that might create some good opportunities because now dealers are more willing to negotiate in terms of purchase new equipment. So if any producers has been able to maintain quite good liquidity for the past several years, there are opportunities to negotiating with a cash payment for large equipment at a relatively low level. So that is something, there's an opportunity on there if there's dealer willing to work with that situation. But really need to think twice if the operation, think twice of purchasing new equipment if the liquidity is a concern for your farm. And then for crop insurance, the sales closing date for Georgia is around the corner, February 28. And this is a map that we created last year about different closing date. But in Georgia, it's February 28 for change your crop insurance decisions or cancel, but I don't suggest for that, cancel crop insurance decisions. So we did a summary about all the different crop insurance products that are available for cotton producers. All the deep loss program, those are the traditional program, yield protection, revenue protection, and revenue protection with harvest price exclusion. Most producers enroll in either of yield protection and revenue protection. And then there are some shallow loss program that which you can add on top of the yield protection and revenue protection. So such as SCO, ECO, stacks, and stacks with harvest price exclusion. And there are some area risk protection, and then the wind index. With the situation of weather change, of hurricane pressures, I suggest that consider about some type of crop insurance to help the farm to cover the potential losses. So this is one chart in Georgia about the average coverage level between yield protection and revenue protection. So most producers in the enrollment acres, most producers enrolled in revenue protection with 70% coverage level, some 75. And in terms of the coverage level or enrollment acre by different crop insurance, we see significant revenue protection over the years compared to the other product, revenue, yield protection, and stacks. And if we add up all the enrolled acres in Georgia and compare to the planted acre, most producers already enrolled in some part of the crop insurance. It just varies among different crop insurance products and varies among different coverage level. So this year, because the commodity prices is a significantly lower, the cost of crop insurance dropped a lot for this year's crop. So that is one part to consider between revenue protection and between different coverage level, whether you want to bump up the coverage level a little bit. Another thing is, so here should be April 15. The sign up for between ARC and PLC for next year is April 15. So make sure that you work with your local FSA office to sign up for different covered commodity for cotton. Commodity for the 2024, as Amanda mentioned, there's around 2.4 cents per pound for seed cotton. And the payment are for 2025 are expected after 2026 or October 1st of 2026. So here summarize the different timing for the PLC and ARC payments. And that's all I want to talk with you for today. And here's my contact information. Any questions? Concerns?
You mentioned the Chinese economy. What's the longer term forecast for the Chinese economy?
Chinese economy longer term forecast by IMF is also not doing very well. So my expectation is Chinese economy won't be able to recover for at least 5 years because of the financial housing market situation. If we think about in 2008, what happened in the US, it took us until the bottom of 2014 to be able to recover back. So the housing situation in China is a lot severe, in my viewpoint, than the financial crisis in 2008. I heard a lot of stories about young people losing jobs, and I see within my family, newly college graduates have challenge in finding jobs. So that is, that is a real situation there. Any other questions? Sorry, couldn't deliver good news. But that gave you some expectations what to do for this year and to prepare for the challenge situation that we're going to face for the coming year. All right, thank you very much.